Welcome to a new video where we analyze stock market behavior using dynamic charts that make it easier to understand the evolution of major companies. Today, we will take a closer look at a key indicator for evaluating high-growth companies: the price-to-sales ratio. Using the image displayed on the screen, we will build a dynamic chart that allows us to visualize the evolution of the price-to-sales ratio of Palantir and Snowflake since 2021. We will analyze how it has changed over time and what this trend might mean in the current market context. The price-to-sales ratio measures how much investors are willing to pay for each dollar of a company's sales. It is a useful indicator for high-growth companies that are not yet profitable, as it allows for comparing the valuation of different companies without depending on earnings. If we look at Palantir's case, its price-to-sales ratio is 92, the highest among companies with a market capitalization above $100 billion. In second place, we find ARM Holdings with a multiple of 44 times its sales, meaning that Palantir's valuation is more than double in comparison. This high valuation indicates that investors have great expectations regarding Palantir's future revenue growth. However, does a high price-to-sales ratio always mean a company is a great investment? Not necessarily. In some cases, companies with excessive valuations may struggle to meet high expectations, leading to price corrections when reality does not match the hype. To better understand this data, let's examine how this indicator has evolved in recent years. In 2021, with the euphoria surrounding tech companies and the rise of software as a service, Palantir traded at high multiples, driven by investor enthusiasm for its business model based on data analytics and artificial intelligence. The period of 2021 was unique in that investors were willing to pay high premiums for companies that promised future technological dominance. This was reflected in the stock prices of many tech firms, where valuations skyrocketed, often detached from financial fundamentals. Snowflake, being another high-growth tech company, also experienced this bullish sentiment, albeit with a more modest multiple compared to Palantir. However, with the correction in the tech market in 2022 and the increase in interest rates, many growth companies experienced valuation declines. During this period, Palantir's price-to-sales ratio fluctuated significantly, while Snowflake, another software company focused on cloud data storage, showed more stable behavior. One major factor that played a role in these shifts was the Federal Reserve's monetary policy. Low interest rates during the early pandemic period fueled an influx of capital into high-growth sectors, but as inflation rose, central banks tightened their policies. The shift from a low-rate to a high-rate environment caused investors to reassess their valuation models, leading to sell-offs in speculative assets. As we moved into 2023 and 2024, we observed a recovery in the tech sector, although with key differences among companies. Palantir has maintained a very high multiple compared to Snowflake, suggesting that the market continues to assign it a significant premium. One of the factors driving Palantir's valuation has been its strong commitment to artificial intelligence development and advanced analytic solutions. As AI becomes a key component in multiple industries, Palantir has positioned itself as a company with a strategic focus on data collection and analysis for decision-making in sectors such as defense, healthcare, and logistics. Snowflake, on the other hand, has leveraged its ability to store and process vast amounts of structured and unstructured data in the cloud, making it an essential tool for companies transitioning toward data-driven decision-making. Unlike Palantir, which specializes in specific, complex government and enterprise projects, Snowflake's business model allows a broad range of customers to adopt its platform. Another relevant aspect of historical evolution is the impact of macroeconomics and monetary policy decisions. During years of low interest rates, many tech companies, including Palantir and Snowflake, benefited from a cheap financing environment. However, as the Federal Reserve adjusted its policy and raised interest rates, the pressure on valuation multiples became evident. If we compare both companies, we can identify some important differences. Business model. Palantir focuses on advanced analytics for government and enterprise clients, while Snowflake offers a cloud platform for data storage and processing. Revenue growth. Snowflake has demonstrated consistent revenue growth with expansion into new markets, whereas Palantir has experienced more irregular growth but has secured major government contracts. Profitability margins. Snowflake has been working on improving its gross margin and operational efficiency, while Palantir still faces challenges in achieving sustained profitability. Customer base. Palantir heavily relies on a few large clients, primarily governments, whereas Snowflake's revenue is spread across a more diverse set of customers in different industries. Although Snowflake currently presents stronger financial metrics, the market continues to bet more on Palantir in terms of valuation. This could be due to the perception that its technology has long-term disruptive potential or simply to greater speculation by investors. Why does the market assign such a high multiple to Palantir? Growth expectations. Investors expect Palantir to expand beyond the government sector and grow in the commercial market. Artificial intelligence trends. With the rise of AI, companies with advanced data analytics technology may be seen as key players in the future. Market confidence. The perception that Palantir can become a tech giant in the long term may be inflating its current valuation. However, it is also important to consider the risks. A high price-to-sales ratio suggests that a company is being priced for perfection, meaning that any misstep in execution could lead to significant downside. If Palantir fails to expand its commercial client base or faces difficulties in its government contracts, its valuation could see a sharp correction. In contrast, Snowflake, despite having stronger financial metrics today, has a lower sales multiple, suggesting that the market is more cautious about its future growth potential. Snowflake has a proven business model that continues to scale with the rise of data-intensive applications, making it a key player in the cloud computing space. This type of analysis helps us understand how the market perceives companies and what factors influence their valuations. While valuation multiples can provide insights, it is always essential to consider other aspects such as real revenue growth, profitability, and long-term strategy. Palantir's price-to-sales ratio remains significantly higher than that of Snowflake, reflecting the market's strong belief in its future potential. However, Snowflake's stable revenue growth, improving margins, and diversified customer base present a compelling argument for investors looking for a solid long-term investment. The question investors must ask themselves is whether Palantir's high valuation is justified or if the market is overestimating its potential. Likewise, is Snowflake being undervalued despite its consistent financial performance? If you enjoyed this analysis, don't forget to check out our latest video, where we explore whether Walmart is a good investment opportunity today, considering its year-over-year sales growth. See you in the next analysis.